All right, so the next standard we are going to deal is the IS 23 borrowing cost, and this is a one-line standard. Like for example, if you have taken the loan to construct a qualifying asset, then that interest cost should be capitalized. Three things you need to know: when to capitalize and to start capitalizing, or when to commence the capitalization. Is the simple thing is when borrowing costs is incurred and the necessary expenditures are done, loan is received. Then when to cease is that when the asset is ready for use, and when to suspend is like, for example, if the construction is interrupted for a specified period of time, and if the construction has been stopped for unspecified period, then that means uh, if the construction stopped for unspecified period, like for example, if there was a construction going on and due to any reason the construction stopped, but they didn't know that how much time it will take to resume, then the capitalization should be discontinued. Okay, then you have the IS 24 related party disclosures, another important standard, and again this is important for this attempt. All you need to know is, first of all, what are the related parties. Okay, then you need to learn this thing. A person or a close member of the person's family is related to a reporting entity if that person has a control or joint control, has significant influence, is a member of the key management. Like for example, if it is a group company, like for example, subsidiary, fellow subsidiary, sub-subsidiary, joint venture, associate, significant influence, or the key member that is part of the management, director, employee, officer, then that is known as the related party. So what is actually the standard? Sorry, the standard is like, for example, if you are having the related party transaction, there will be transaction with the related parties, then that should be disclosed irrespective of the amounts. So whatever the amounts are, that should be disclosed. Similarly, disclosure of personal guarantees given by the directors in respect of borrowings by the reporting entity should be disclosed. Like for example, if I'm the director of the company and I'm giving a personal guarantee on the company's loan, then that should be disclosed as well. Government-related entities, like mostly the semi-government institution, they have some different disclosure requirements, and you can read that as well. Okay, then this is something very important. Why it is important to disclose the related party transactions? Okay, this is something you need to know. This can be tested in the exam as well. So this is something again important. Okay, then you have IS 27, leave it, and then you have IS 28. We are not talking about these standards. Okay, investment in associates. When I will be discussing the consolidation revision, I will discuss how to account for the IS 28. But remember one thing, that IS 28 is simply we are not having the control, we are having the significant influence. That means we can participate in their financial and operating policies, but we do not have the control. That means that this should not be consolidated, rather equity accounting should be performed. And equity accounting means that one figure should be recorded in the statement of financial position and the other figure is recorded in the statement of profit or loss. All right, so this is something, like how to account for regarding the associate. Then you have financial instruments. And if you see, I have written three standards. One is the IS 32, which is the presentation of the financial instruments. And the second thing is IFRS 7 is the disclosure of the financial instrument. When you are talking about the presentation of the financial instrument, at where it should be presented, current assets, non-current assets, what name, where gains and losses should be recorded. All those things are dealt by IS 32. Then you have IFRS 7, financial instrument disclosures, that defines that to what extent the entity should disclose and how many things should be disclosed regarding financial instrument. That is IFRS 7. Okay, like for example, what type of risks company is taking, in which market the company has invested, what type of instruments they are actually investing in, or for example, if they have the hedging, what type of hedge instrument they are using, and which type against which hedge item, all those things should be disclosed. Then when you talk about the main treatment, it is IFRS 9 financial instruments. So first of all, financial instrument is again important standard, but again when you will be having the financial instrument in the exam, then the examiner will not be talking about the complete IFRS 9. Obviously, there will be a component of IFRS 9 which will be tested in the exam. So let's just divide this standard into few things. So we will be talking about the financial asset. We'll be talking about the financial liability. We'll be talking about impairment of financial asset. We'll be talking about the convertibles, and we will be talking about the hedging. So these are the 5 things we are going to discuss in the financial instruments. So first of all, let's come to the financial asset. Okay, when we are talking about the financial assets, so IFRS 9 defined that okay, it is either the investment in equity instruments. That means you are investing in the equity instrument of another entity, such as you are buying the shares of another company. So normally when you talk about the investment in equity instrument, so these are the speculative investments, these are the short-term investments, and the gains or losses should be recorded in the profit or loss. That is known as fair value through profit or loss. That you will be measuring your financial asset at the fair value, and then you will be remeasuring it at the reporting date, and gain or loss goes to the profit or loss. But the entity can choose to elect the gains in the other comprehensive income as well. That is fair value through other comprehensive income. When we classified in the other comprehensive income, normally those are the cases in which we have the strategic intent. And in those cases, strategic intent means that we'll keep the financial asset for some time, and then it will be traded. And then this is the strategic intent. And in those cases, the gain and losses should be recorded in the comprehensive income. So investment in equity instrument is simply either fair value through profit or loss, or fair value through the comprehensive income. So that is completely dependent on the election of the company, what they are going to do. And then you have the investment in debt instruments. The entity is buying the debt instrument of another entity, such as loan notes. So normally it can be, if it is for trading purpose, then again fair value through profit or loss, fair value through other comprehensive income. But if that meets 2 tests, cash flow characteristic test and business model test, in those cases, then it should be recorded amortized cost. Amortized cost is not something the gain or loss. Amortized cost is simply the working that, okay, when you're talking about the financial asset, it will be recorded in the non-current assets, and the income, which is the interest component, will be recorded in the profit or loss. So cash flow characteristic test means that the financial asset is simply a principal payment and interest and none other than that. And the business model test means that it will be kept till maturity and you have no intention to trade that financial asset. Then you have the financial liability. Financial liability is something normally we are going to pay off, and so that means it should be recorded at amortized cost. So initially fair value less issue cost less any discounts, rebates, and then it should be recorded as amortized cost, and the finance cost component is charged to the profit or loss. Then you have impairment of financial asset. Okay, impairment of financial asset, what does that mean? Impairment of financial asset. Impairment of financial asset is simply like, for example, you have a financial asset such as you have the loan notes. You have bought the loan note of another entity, which is the debt instrument. And you know, when you have bought the loan note, that means you have the contractual right that you will be receiving some cash flows over the period of, like, for example, 3 years, 4 years, 5 years, whatever the loan note is. So there is actually a contractual right that you will be receiving some cash flows, and by the end or the maturity, you will be getting your principal payment back. So now, for some reason, the bond or the loan note has suffered some impairment. Like the contractual cash flows are less than the expected cash flow due to any reason, for example, stock market crash, economic problems, whatever. So if your expected cash flows are less than the contractual cash flows, and that means your financial asset has been impaired. Although this is something expected, impairment is actually, these are the indicators. So basically you are going to be proactive over here. So what you will be doing, you will be recording the impairment, debit, profit or loss, credit, financial asset. And although it has some relief that if later on you think that the stock market has recovered or the market has recovered and now the things are better, then you can reverse that impairment which you have charged. Sorry. Then you have the convertibles. When you're talking about the convertibles, so that bond should be split between current and, sorry, the bond should be convertible. The bond should be split between the debt and the equity. Because what is the convertible? Convertible is simply the loan note which gives the right to the bondholder that they can take cash or they can convert their investment to shares at the maturity. So from the very start, the company is going to split that convertible into debt and equity, and that is again the amortized costing, and the OCE as the components of equity will be recorded in the statement of changes in equity till it is decided at what they're going to do. Then you have one thing, although like if you have seen some calculation of the hedging, maybe it seems quite difficult to you, but remember one thing, that you'll not be having those calculations in the exam. You just need to know what is hedging. First of all, what we are doing in the hedging, this is not the hedging, this is hedge accounting. So what we're going to do in the hedge accounting is simply we have the hedge item which is going to be hedged, and then we have the hedge instrument through which the item is going to be hedged. So hedge item which is going to be hedged, and then you have the hedge instrument through which the hedge item is going to be hedged, which is actually a product given to you by a financial institution. So such as options, swaps, futures, whatever. So what you're going to do is hedge accounting is simply mean that when you do the hedging, that means you are managing your risk. And when there are changes, so these two things, the hedge items and hedge instruments, they actually move in the opposite direction. So what you're going to do is you are going to offset the gain or loss of hedge item with the gain or loss of the hedge instrument. So what you're going to do is you are going to offset those things. So the first thing you need to know regarding the hedging is that the hedge should be effective. The hedge effectiveness. Hedge effectiveness is something like, for example, if you are having both the gains in the hedge item and an instrument, that hedge is not effective. Similarly, when you're having the losses in both, then the hedge accounting objective is not met, which is the offsetting. The objective of the hedge accounting is the offsetting. So the first thing, that the hedge effectiveness, and the hedge effectiveness has many things in it, such as there should be a proper relationship between the hedge item and the hedge instrument. The hedge item is not the hedge instrument is not a general thing, it is for a specific hedge item. And that there are two types of hedge, the fair value hedge and the cash flow hedge. When you are actually hedging the fair values of an item such as inventory, non-current asset, then that is a fair value hedge, and the net gains or losses go to the profit or loss. Unless and until you are hedging an instrument whose normal gain or losses go to the other comprehensive income, then the hedge gains and losses will go to the OCI as well. Like for example, if you are hedging something whose gain or losses go to the other comprehensive income, like the property, plant and equipment revaluation, then in that case, like for example, the gains and losses will be recorded in the OCI. Similarly, when you have the cash flow hedge, when you are managing your receipts or payments, in those cases, the gains or losses should be recorded, first of all, in the OCI. And if they are excessive gains, like the cash flow hedge, obviously at this stage you are not going to understand the calculation perspective of this thing, but make sure that you are just going to remember the accounting treatment, which says The cash flow hedge, there are two types of gains: effective, ineffective. Ineffective means excessive. So effective gains. Effective gains are those gains which the gain of the hedge item is equal to the hedge instrument. The effective portion goes to the other comprehensive income, and the excessive portion goes to the profit or loss. If you have this thing in the exam, make sure first of all you are writing the hedge effectiveness criteria. Let me show you where it is in the notes. Yes, this thing, this criteria, you're writing in the exam. And if you have the receipts of the payment, you will be writing the cash flow hedge. And this is the criteria for the cash flow hedge. If you are hedging the items, then you have the fair value hedge. So if in the exam, they are just talking about the theory, then you will be writing first of all the criteria, and then the fair value hedge, and then the cash flow hedge. So this was your IFRS 9, and there's no need to be afraid of that how you're going to tackle this thing in the exam. It is going to be a theoretical part rather than numerical part. But if there is some numerical part that will be regarding convertible, the amortized cost working, which you have already seen in your full course, that how those calculations are made. Another important standard is impairment of assets, which is IAS 36, which says that an asset should be recorded an asset should be recorded at lower of its carrying value and recoverable amount. Carrying value is the book value, and recoverable amount is higher of its value in use and fair value less cost to sell. This is important as well. So carrying value is the book value, and recoverable amount is higher of value in use is actually the present value of future cash flows. Maybe you are required to calculate the value in use. You just need to take two things. Take the year, take the cash flow, take the discount factor, and then calculate the present value. So the NPV is actually the value in use. But make sure you are not taking the cash flows for more than 5 years. And fair value less cost to sell is the market value less any cost to sell. So value in use and fair value less cost to sell, the higher will be the recoverable amount. And then if the carrying value is higher than the recoverable amount, an asset is said to be impaired, and impairment should be charged. So while you are charging the impairment, you need to see whether this asset was previously revalued. In that case, that first of all, that revaluation surplus should be de-recognized. And if then there is further impairment, that should be charged to the profit and loss. Similarly, if you are talking about an asset which was not previously revalued, then the impairment and loss directly goes to the profit or loss. Then you have the reversal of impairment, another important thing which is in IAS 36. Like for example, like I said, and if you are actually going to impair the asset which was previously revalued, so first of all, you are going to reverse that revaluation surplus. And then extra impairment goes to the profit and loss. Then similarly, if that asset recovered the value again, then first of all, you need to reverse the impairment charge which was charged to the statement of profit and loss, and then extra gain should be recorded to the revaluation surplus. Impairment has indicators, external, internal. External indicators may include like changes in the regulations, market values, technological changes, changes in the interest rates, and internal indicators might include obsolescence, damage, change in the policy, redundancies, and redundant asset, change in the key staff, all those things. And then you have the last concept, which is the cash generating unit. So if you are having full cash generating unit, then the value of the CGU, carrying value of the CGU, should be compared with the recoverable value of the CGU, and the gains or losses are, if the carrying value of the CGU is greater than the recoverable amount, then impairment. Impairment is again, first of all, charged to the specified asset, goodwill, and other assets on pro rata basis, and assets which are already on the recoverable amount should not be charged impairment. Then you have another standard IAS 37. Again, you will be having some specific situation in the exam. So you need to see, like for example, if they are saying, first of all, these are the specific situation. when to record the provision, when to record the contingent asset, and when to record the contingent liability. So like we need to see inflow and outflow. If the inflow is virtually certain, like say for example, if they were having they sued someone and they are virtually certain that they will be recovering some amount in compensation, then that should be recorded as the asset. Similarly, if their inventory got damaged and the insurance company is saying, okay, we'll pay you, then this is virtually certain, then they can record it as asset. But inflow can only be recorded as an asset if it is virtually certain, that means more than 95%. In other cases, if it is probable, then the contingent asset should be disclosed, and if it is possible or remote, then no thing should be done. Similarly, in the case of provision, if the outflow is virtually certain or the probable, provision should be created. In the case of possibility, the contingent liability, and in the case of remoteness, nothing. So then you have the specific situation in the exam. So future operating losses, no provision should be recorded. Then you have onerous contracts which are going to occur the loss. Straight away loss should be recognized. Then you have environmental provision. Then you have restructuring is very important, even tested in the last attempt as well. So when the entity has a formal plan and that thing is communicated to all the stakeholders, then provision should be recorded for the direct amounts. So, sorry. Then you have the shortcomings of IS 37. Give it a read, just give it a read. Yes. Important, and read. Make sure that you are done with the notes. But if you are still not done with the note, then I can do nothing regarding that. Intangible assets, just like other tangible non-current assets. First of all, it should meet the criteria of the asset, and then it has a separate criteria which is identifiable non-monetary assets which has no physical existence. So intangible asset, the mainly internally generated intangible asset should not be capitalized, and if you have purchased, that should be capitalized. Then you have research and development. So research should not be capitalized, development should only be capitalized if the criteria is met. And then you have, the intangible assets which have definite life should be amortized, and intangible asset having indefinite life should be impairment tested. And such as training cost should not be capitalized, and internally generated assets should not be capitalized, blah, blah, blah. Then you have another less important standard, investment property, but it can be tested in the classification thing. When you have the tangible non-current asset and it is for, something like capital appreciation or to earn rentals or both, then that should be recorded in IS 40 and yes, IS 40. And it has again two model, cost model and the fair value model. The fair value model is a bit different from IS 16 because in IS 16 the gains and losses were recorded in other comprehensive income, but here it will be recorded in the profit and loss. In the IS 16 there was depreciation, but here there will be no depreciation. And then you have IS 41 agriculture. So if you have the biological assets or the agriculture produce, it should be recorded fair value. At each reporting date, it should be remeasured and gain or losses are recorded to the profit or loss.